Good afternoon, everyone. Today I'd like to talk to you about the Treasurer's budget that was handed down last night. Now, there was much speculation around this budget and we were all very clearly forewarned that as Australians we're all going to need to contribute to the pain of fixing our national budget. Overall, the result of this budget, once implemented, will be that the deficit in Australia will fall from its current $49 billion to $29 billion next year, and then a further fall to a deficit of just under $3 billion in the 2017-18 financial year. Last night there were many changes announced, but for many clients the changes probably to social security and the temporary budget levy that's being introduced will provide the most impact. So let's try and break it down. In terms of superannuation, what the government are proposing is that the superannuation guarantee rate be increased from 9.25 to 9.5% effective next year. Now that's as legislation currently stands. It's going to remain though at 9.5% until the end of June 2018, and then increase by 0.5% every year until it reaches 12% ultimately in 2023. Now, what does this mean? I guess from an employer perspective, it just now provides some certainty, given the government's previous failure to pass legislation to otherwise leave that rate at 9.25 until the year 2017. In terms of superannuation preservation ages, no change has been nominated for that, although the government has indicated that this still will be up for consideration at some point, so watch this space. From a tax perspective, our personal marginal tax rates remain unchanged, but there is this temporary budget repair levy being introduced. That's going to mean that our higher income earners are going to pay more tax than they normally would be in the 2014 financial year, i.e. the one we're in now, and also for the ensuing 2 years. Now, it's only going to affect those that have taxable incomes of $180,000 or more. People earning less than $180,000, no levy to be paid. Those earning more than $180,000 will pay the levy at the rate of 2% of the amount over the $180,000. So, for example, if someone has taxable income of, say, $200,000, they will pay the 2% levy on $20,000 of that, being the portion above $180,000. Thoughts around that? I guess what this means is that individuals that are looking like they're going to be affected by this levy might want to consider deferring some of their tax deductions into the next tax year, or even perhaps bringing forward income receipts into the current tax year where possible. Company tax rate changes are going to mean that the rate of the currently 30% is going to drop by 1.5%, effective from July 2015 down to 28.5%. So for large companies, this reduction will in fact offset the paid parental leave scheme, which we'll talk about shortly. It might also cause some reassessment of business structures and will provide a flow-on effect in terms of franking credits as well. The other impact that this will have will be to insurance bonds who are currently taxed at the same rate as companies, i.e. 30%, but whose rate will now also fall to 28.5%. And that's going to make them potentially a more viable option for some investors. The budget proposes an increase in the fringe benefit tax rate to 49% from April 2015 and through until March 2017, coinciding, of course, with that temporary budget repair levy. Now, that might give individuals that are liable to pay the TBRL, or the temporary budget repair levy, the opportunity to salary package certain benefits at the lower fringe benefits tax rate that applies outside of that time frame. With Medicare, there's been some changes proposed to the low income threshold for families, increasing from $33,693 to $34,367, and also from a Medicare levy perspective, we saw in last year's budget the introduction of the disability care and the subsequent increase in our Medicare levy by 0.5% to fund it. This levy is going to increase again by a further 0.5%, which will take it up to 2% effective from the 1st of July 2014. For the 3 years from July 2015 through to the end of June 2018, the Medicare levy surcharge and the private health insurance rebate thresholds will not be subject to any indexation. From July 2015, though, what the government is proposing is a $7 charge for each visit to a bulk billed general practitioner. That $7, however, will be capped at 10 services in a calendar year. So, for example, if you have been to the GP 10 times, your 11th visit won't incur that $7 charge for a bulk bill visit. So because the liability to both the Medicare levy and the TBRL will be assessed on taxable income, sorry, and I'll just go back, TBRL, so I'm not speaking in jargon, relates to this temporary budget repair levy. So because the liability to both that and Medicare levy will be assessed on taxable income, any tax deductions, so for example interest on an investment loan, will reduce the potential liability to those levies, as will salary sacrificing to super or making personal tax deductible contributions to super where eligible, therefore converting taxable salary to exempt or concessionally taxed fringe benefits where possible, having the impact of potentially reducing those levies. From a social security perspective, the government has announced it's going to abolish the mature age tax offset from July this year, and the savings from that measure are going to be redirected to the government's expanded seniors employment incentive payment, which they have nicknamed Restart. Now that's being implemented as a means to support mature age job seekers in their quest to re-enter the workforce essentially. And there's going to be payments made of up to $10,000 to employers who choose to hire a mature age job seeker, mature age being 50 years or over, and who have been receiving income support for 6 months. Further into changes around social security, also being abolished from July this year will be the dependent spouse tax offset for all taxpayers. The contentious issue of age pension and the qualifying age, it will continue, that is the qualifying age for age pension, to increase every 6 months, will continue to rise by 6 months every 2 years, so that by 1 July 2035, as we've all heard in the media of late, the qualifying age for age pension will in fact be 70. Now it's important to note anyone born before the 1st of July 1958 won't be affected by this measure. Clearly there's going to be some impact on clients' proposed future retirement dates, which means that financial planners such as myself will need to work more proactively with their clients to adjust their financial plans and the relevant modelling to ensure adequate retirement savings if the client's plan is to retire before age 70. Further changes around deeming rates, the thresholds are going to be brought down and reset to $30,000 for a single person and $50,000 for a couple. Currently these are $46,600 and $77,400. Now if we assume that the current deeming rates continue to apply, the lower thresholds will no doubt result in clients having higher deemed income under the Social Security income test. Now this could negatively impact strategies that include account-based pensions, for example, that are commenced after January 2015, and we have talked about these before in one of our previous video clips that we've sent you. So given those changes that are going to be effective after 1 January 15, this could be a big game changer in terms of a retiree's income stream and how the strategy is put together. Currently, many Social Security related payments are indexed in line with the higher of the increases in CPI or the male total average weekly earnings. From September 2017, so not too far away, so certain social security payments, including age pension, will be indexed only by CPI. Now, that new arrangement is going to lead to a comparative reduction in the growth of the affected pensions or allowances. And as a result, and to maintain a particular standard of living, a particular lifestyle, clients may need to rely more on their own capital, and cash flow needs will require closer monitoring by the client and by myself. The family home will continue to be exempt as an asset regardless of its value. In terms of New Start allowance and sickness allowance, the government is implementing a minimum age to qualify for these benefits, and that's going to increase to 25 years for any new applicants to these benefits after the 1st of January 2015. So you must be 25 to be able to apply. Other incidental changes that have been brought about as a result of last night's budget: the first home savers account, is going to be abolished. For the 2013 financial year, existing account holders will continue to receive the government co-contribution to those accounts and all the tax and social security concessions. However, the co-contribution is going to cease from 1 July this year, and then the other tax and social security concessions will be withdrawn from 1 July 2015. At that point, on 1 July 2015, that first home savers account will revert to just a normal savings account with whatever institution it's held, and account holders will be able to withdraw the full balance without any restriction. Another change that's been indicated in last night's budget was around the Defence Force retirement benefits and military superannuation fund. So from July 2014, members of that scheme that are aged 55 and above will have their superannuation benefits indexed by the higher of CPI and the pensioner and beneficiary living cost index. Further to that, Australian Defence Force members will now be able to choose which superannuation fund they belong to, and for the first time will actually have the ability to transfer their accumulated benefits to a new fund if they leave the Australian Defence Force, something they've never been able to do before. From 1 July 2016, so just over 2 years from now, a modern and fully funded accumulation super scheme called ADF Super will exist for new members entering the ADF. The existing military superannuation fund will be closed to any new members from that date. There won't be any changes made at all to superannuation arrangements for existing military super members, but they will have the option to move to the new arrangements under which the government will pay a 15.4% contribution, or during periods of warlike service 18%. What does this mean? I guess this really opens up a whole world of opportunity for members of the ADF, allowing them to maximise their wealth creation opportunities and to really take control of their retirement savings. Paid parental leave. So from 1 July next year, that's 2015, the government will deliver the paid parental leave scheme, which is going to provide 6 months paid leave, including superannuation, with an annual cap on pre-birth earnings of $100,000, meaning a maximum payment in the 6-month period of $50,000, which includes superannuation. And the last note I have here is regarding fuel excise, which for some of you may be interesting. Indexation of fuel excise is going to be introduced from the 1st of August this year, with the goal of securing more stable funding for additional road infrastructure projects. Biannual indexation by the CPI of excise and excise equivalent customs duty will be reintroduced for all fuels except for aviation fuels. Now, the current excise rate on fuels had been frozen for the last 13 years, and that was something that was abolished in 2001 by the Howard government. An automatic effective price rise on fuel twice a year may lead to an increase in the cost of goods and services in the event that the increase can't be absorbed by businesses. What I've talked about today is really just the more pertinent points that we've gleaned from the budget papers since its issue last night, and hope that some of that information might be relevant to you. If you would like further information or clarity around any of that stuff that we've talked about today, please just give me a call and I'm happy to talk you through what those changes might mean for you in your circumstances. Tracy Ferguson. Thanks for listening.